Oil prices dropped. So why does everything still feel more expensive? The crisis may be fading from headlines, but for millions of people around the world, the real impact is just beginning. When oil prices surged in early 2026, the world focused on markets, war, and headlines. But behind the scenes, something slower and more powerful was happening. Costs were spreading. According to experts, energy costs don't just affect fuel. They ripple through the entire economy. From transportation to food production to electricity, oil is embedded in almost everything people use daily. So even though Brent crude has dropped back to around $92, the effects haven't disappeared. They've just moved downstream. At first, the impact was obvious. Gas prices jumped. According to data, US gasoline rose by about 50 cents in a single week during the peak. But then came the second wave. Transportation companies began adjusting prices. Shipping costs increased. Airlines raised ticket prices, and businesses followed. Because when it costs more to move goods, it costs more to sell them. Data shows that higher diesel and fuel costs directly increase the price of food, clothing, and everyday essentials. Even industries people don't expect, like e-commerce, were affected. Delivery became more expensive. Margins shrank. Prices adjusted. Then came the moment most people didn't see. Inflation didn't fall. It stayed elevated. According to reports, US wholesale inflation reached 2.9%, well above expectations. And consumer inflation remained around 3.3%. That changed everything, because central banks, including the Federal Reserve, were forced to keep interest rates higher for longer. This is where the real pressure begins. Not in oil markets, but in everyday financial life. Now the effects become personal. Higher interest rates mean mortgage payments increase. Credit card debt becomes more expensive. Car loans cost more. For many households, this creates a squeeze. Income stays the same, but expenses rise from every direction. At the same time, rent prices remain elevated. Food prices adjust upward. Energy bills fluctuate. According to economic data, this combination reduces real purchasing power. In simple terms, people can afford less, even if they earn the same. Globally, the situation varies, but the pattern is similar. In developing economies, higher energy costs hit even harder, because fuel and food make up a larger share of household spending. As of April 2026, the situation is stabilizing, but not fully recovering. Oil prices have pulled back, but inflation remains above targets. Interest rates are still elevated. Growth forecasts have been reduced. According to economists, growth in key regions has slowed significantly, and data shows that global growth is now expected around 2.9%. Markets are adjusting, but households are still absorbing the shock, because economic effects don't disappear overnight. They linger. So what can we learn from this? The biggest impacts are delayed. The headlines fade fast, but the financial effects last longer. Energy shocks hit everyday life hardest, not through markets, but through bills, loans, and prices. Stability doesn't mean recovery. Just because oil dropped doesn't mean costs go back immediately. Financial resilience matters. Savings, budgeting, and debt management become critical in times like this. This crisis showed something important. The global economy isn't just numbers and charts. It's people. And when systems get stressed, ordinary people feel it the most. The oil shock may be fading, but its effects are still moving through the system, quietly, slowly, and globally. The far-reaching consequences of this dynamic are not just about numbers on a spreadsheet. They reshape daily lives, altering spending habits and redefining priorities. Households are forced to rethink budgets, cut non-essential expenses, and find new ways to stretch a dollar further. Meanwhile, businesses grapple with how to maintain profitability without alienating consumers who are already tightening their belts. As industries across the globe continue to adapt, the ripple effects of the oil shock serve as a stark reminder of the interconnectedness of modern economies. The price of oil, a single commodity, manages to touch every facet of life, from the cost of a loaf of bread to the price of a plane ticket. The dependency on oil and fossil fuels poses questions about energy diversification and sustainability in the face of future shocks. The ongoing narrative of rising prices against a backdrop of falling oil costs illustrates a complex web of economic factors at play. It highlights how initial market reactions can give way to deeper, more persistent economic shifts that are felt long after the headlines have moved on. This is not just a story about oil, it's a story about resilience, adaptation, and the enduring impact of economic turbulence on human life. The journey through these economic changes is far from over. It's a continuous evolution that challenges policymakers, economists, and everyday citizens to navigate a path forward in a world where stability is often elusive. How long can people keep absorbing the pressure? The question remains open, echoing in the lives of those who continue to feel the weight of economic realities, shaping a future that is uncertain yet hopeful. As the world grapples with the aftermath of the oil shock, the complexities of global supply chains have come into sharper focus. These intricate networks, which once operated like well-oiled machines, now face disruptions that exacerbate the cost of living. A single increase in oil prices can send ripples through these chains, affecting everything from the availability of goods to their final price on store shelves. Consider the journey of a simple product like a smartphone. The parts are sourced from multiple continents, assembled in a different country, and then shipped worldwide for sale. Each step in this process is heavily reliant on affordable energy. When oil prices spiked, shipping costs surged, and delays became more frequent, adding both time and expense to production cycles. This has forced companies to reevaluate their supply chain strategies, with some opting to bring production closer to home, a trend known as reshoring. Reshoring not only addresses logistical challenges, but also highlights a shift in economic strategy as countries seek to reduce dependency on volatile international markets. Yet, this transition is not without its own costs. Domestic production often comes with higher labor expenses, which can negate the savings from reduced transportation costs. As businesses navigate this new landscape, consumers are caught in the crossfire, facing higher prices even as companies attempt to stabilize operations. In the agricultural sector, farmers have been hit particularly hard. The cost of fuel needed to power tractors, combine harvesters, and other machinery has risen, inflating the cost of food production. Fertilizers, many of which are derived from petroleum products, have also become more expensive, compounding the issue. For farmers, these increased costs result in thinner profit margins and ultimately higher prices at the grocery store. Moreover, the impact of the oil shock has underscored the vulnerability of countries heavily reliant on food imports. For nations in the Middle East and Africa, where arid climates limit agricultural output, the increased cost of importing food has strained national budgets and raised concerns about food security. These regions, already grappling with various socio-economic challenges, find themselves in a precarious position as they navigate the dual pressures of rising costs and political instability. The energy sector itself is undergoing a transformation as a result of these challenges. The oil shock has accelerated the global push towards renewable energy sources. Governments and businesses invest in wind, solar, and other sustainable technologies. This shift promises a more stable energy future, but requires significant upfront investment. It also requires time to develop the necessary infrastructure. For now, fossil fuels remain a dominant force, with renewables slowly gaining ground. In financial markets, The sustained high prices and economic uncertainties have led to volatility. Investors, seeking safe havens, have turned to commodities like gold. This has driven up prices in precious metals. Stock markets have experienced turbulent swings, reflective of the broader economic instability. Central banks, balancing the need to control inflation without stifling growth, have found themselves walking a tightrope. Interest rate hikes, while necessary to curb inflation, also risk slowing economic recovery. This increases borrowing costs for businesses and consumers alike. Amidst these macroeconomic shifts, individual stories of resilience and adaptation emerge. Families are finding creative ways to manage budgets, such as growing their own vegetables. Some are carpooling to save on fuel. Community initiatives, like local barter systems and cooperative buying groups, are gaining popularity. These provide a buffer against the economic shocks. The oil shock has also sparked discussions around energy policy and sustainability on a global scale. Policymakers are debating how best to ensure energy security while minimizing environmental impact. Carbon taxes, incentives for green technologies, and stricter emissions regulations are on the table. Implementation varies widely by country, influenced by political considerations and economic capabilities. Education systems are responding too, with new curricula focusing on sustainability and energy efficiency. Universities and research institutions are ramping up studies on alternative energy and sustainable practices. They recognize the critical role innovation will play in navigating future challenges. As these discussions unfold, the narrative of the oil shock continues to evolve. It's a story of interconnectedness, where the actions of one sector can have profound impacts on another. It's also a reminder of the importance of resilience and adaptation in an ever-changing economic landscape. The world watches closely, aware that as oil prices stabilize, the lessons learned during this period will shape not only current policies, but also the future direction of global economies. The journey is far from over, with each development adding a new layer to an already complex tapestry. As the world continues to navigate the aftermath of the oil shock, the social implications become increasingly evident. In many urban centers, public transportation systems are seeing a resurgence in use. With fuel prices remaining unpredictable, more commuters are opting for buses, trains, and bicycles. This leads to increased investment in public infrastructure. Cities are experimenting with greener options such as electric buses and expanded bike lanes. Both aim to reduce reliance on fossil fuels and address environmental concerns. The ripple effects of the oil shock have also prompted shifts in consumer behavior. People are becoming more conscious of energy usage. There is a surge in demand for energy-efficient appliances and home retrofitting. Solar panel installations have increased as households seek to reduce electricity bills. This shift not only helps mitigate immediate economic pressures, but also contributes to longer-term environmental goals. In the corporate world, businesses are re-evaluating their operational models. Many are implementing energy-saving measures and exploring digital solutions. Remote work, initially a necessity during the pandemic, has become a strategic choice. Some companies look to cut costs and reduce emissions. Globally, the oil shock has accelerated dialogue around international energy cooperation. Countries are sharing technologies and strategies to enhance energy security, understanding that collaborative efforts are key to building resilience against future shocks. This period of economic adjustment offers a crucial opportunity to rethink and reshape approaches to energy. As these transformations unfold, the world stands at a crossroads, facing the challenge of building a more resilient and sustainable future. The road ahead is uncertain, but full of potential.